So if you looked at our last 3 videos and made up your mind that you will save 10 to 15% of your income and start investing it, and suppose you go and Google investments or you look at the social media, you may hit a brick wall. There are literally hundreds of products out there for you to invest in. So how do you choose between these investment products? So should you go by Mutual Funds Sahi Hai and start SIPs in mutual funds? Or should you listen to your elderly relative who says buy a LIC policy or a plot of land? Should you go by your friend who's really made it big in the stock markets and try out stock market trading? Well, instead of trying to figure out what investment you should choose based on social media inputs or other inputs, just go by what investment fits your needs. Here's the framework for you to do that. So as you saw in the first video, emergencies can happen to anyone. This is why financial experts say that all of us should have an emergency fund even before we start investing in any other option. An emergency fund should be equal to about 6 months expenses is what they say. But actually it is better if you have about 9 months expenses. So suppose your monthly expenses are about 50,000, it means that you need an emergency fund of about rupees 4.5 lakh. Now if that looks like a big number, you need not get it overnight, you can build it over time. So your emergency money should only be parked in instruments which are safe, where you won't lose capital and from which you can withdraw your money at any time, because emergencies are not going to come with notice. What are these options? You can start a recurring deposit with the bank with which you have your savings bank account, or you can put a fixed deposit in the same bank. Now both these options will give you much higher interest than your savings bank account. You cannot do SIPs in mutual funds etc. to meet your emergency needs, because these are market linked investments where the returns cannot be predicted. If you have short term goals coming up within 3 years, it could be replacing your phone, going on a vacation, things like that, then where do you save and invest money? Again here equity funds are a no-no and equity stock markets are a no-no, because stock markets can go sharply up and down in this period. Of course you can't go to real estate or LIC policies. So where do you go for investing 3-year money? FDs with your own bank can be one option, or you can shoot for slightly higher returns with FDs from NBFCs. When you are doing this, go for higher rated NBFCs with AAA ratings like Sundaram Finance, Bajaj Finance or Mahindra Finance. There are also certain categories of mutual funds which can actually help you save money for 3 years. It's very difficult to choose between the large variety of debt funds. So one category of funds you can go with is money market mutual funds. These are funds which only invest in government securities. What if you have goals that will come up in 5 to 7 years? Now many people will say go for equity, but I am not so sure, because what if a bear market arrives when you just want to withdraw your money? So again I would say go in for debt options, the corporate FD, the FDs with NBFCs that we mentioned earlier, those are good fits. Apart from that, you can look for the 5-year national savings certificates from the post office as an absolute cast iron option. It's a safe one because it's backed by the government of India. Alternatively, there are some kinds of mutual funds which you can choose for 5 to 7 year goals. These are corporate bond funds which invest only in high quality corporate bonds are a good option. If you take a little bit of risk to your capital, then funds like balanced advantage funds or hybrid funds, these can also be good options for 5 to 7 year goals. If you are the organized type and know exactly where you want to be in life 7 or 10 years from now, then you can consider some of the riskier options that are there on the investment menu. So stocks are one option, and to invest in the stock market directly, you should know how to pick stocks or how to actually analyze companies. If you can't do that, you can go for equity mutual funds. To start with, you can start SIPs and index funds, which are the simplest product available. There is also the national pension system, which actually takes your money and puts it into stocks or bonds in the market. There are also gold ETFs or sovereign gold bonds available to you. Now suppose even with your long term investments you can't take any fluctuations in your returns, then there are a few options for you. One is the public provident fund or the PPF account. You can open a PPF account via any bank or via the post office, and it gives you a very decent return of 7.5%. This is a 15-year account. There is also the employees provident fund which you opened as soon as you joined your job and your money is accumulating there. That is also a good option. Finally, there are 10-year bonds from the government or from other companies from time to time which come to the market and raise money from the public. So, many of these long-term options are also the ones that can make you rich over the long term. So, in our next video, let us discuss a very often asked question in which many people are interested, which is that should you invest in the stock market?